today another episode of things to avoid, and we're going to talk about something very important to avoid, which is signing as a guarantor for someone else's loan. Now, those of you all that would have accessed loans before, you know that there are certain qualifying factors. You normally have to have some sort of collateral, something down in the credit union or bank that they could actually hold as security in the event that you do not repay the loan. You have to have stable employment. There's a number of things, form of IDs, all these things, depending on what kind of loan it is. If it's a very large loan, it's a mortgage loan, they may need you to have life insurance and all these other things. Now, in the case of persons who are not permanently employed, or their employment might be seasonal, off and on, or in the analysis to determine whether you qualify for a certain loan, they may realize that it may be a risk upfront giving you this loan, because you may not be in a position to really repay the loan after a certain period of time. They may require you to have someone sign as a guarantor. And I'm going to give you an example of what might be a disqualifying factor that may prompt them to have someone sign as a guarantor. In the event that, let's say you now finished your bachelor degree and you have, say, $20,000 in your account, and you require a $120,000 loan to purchase a vehicle, and the employment you got is a 2 months renewable contract, which means every 2 months the contract is renewed. It's not permanent. After 2 months, they may decide whether to extend your contract or let you go. So something like this, a financial institution may look and realize it's not too stable. The employment is not stable. This $120,000 loan you are requiring, you need 2 years to repay it. And if after 2 months your contract is not renewed, there's a problem, as to how you're going to repay this loan after 2 months. So they require you to have a guarantor, someone sign as a guarantor. It could be a parent, it could be a sibling who is in a more stable position, it may be an aunt, anyone, it could be a friend. Now the thing about it is that this guarantor, they are more or less, why they are a guarantor, they're actually providing a guarantee to the financial institution that in the event that this person, if something was to happen that makes them unable to repay their loan, and we're talking about the borrower, then the guarantor will more or less guarantee that payments are continued by them. So the guarantor will continue to make payments on behalf of the borrower in the event that the borrower is not able to continue payments. So this is why they call him a guarantor. And when you sign as a guarantor, you are more or less given a guarantee to the financial institution that you are the person that will continue paying in the event that the borrower cannot continue. Now they could also require you to put guarantees in terms of collateral. The guarantor may have the option of either continuing payments or upfront putting down, say, $100,000 as collateral in the event that the borrower cannot continue making payments. Then the financial institution will seize that collateral and utilize it to complete the repayment. So the question is, should you sign as a guarantor? And I always say you have to look at it on a case-by-case basis. I personally would not like to sign as a guarantor for someone else's loan, because I know in the event I can't control their employment, and if this is something I may be helping them with, they would not get the loan unless someone signs a guarantor. And if I sign this and say, for instance, they lost their employment, then it's down to me now to continue the payments. And if I have collateral set up, if I have a collateral agreement, I offer something like my house as collateral. In the event that they default on their loan, then I am at risk of losing that asset. So you have to be very careful when it comes to signing as a guarantor. You have to really assess this person and determine whether their employment, and you generally have to do the same thing the bank is doing, the bank or the credit union, whichever financial institution it is. They would have assessed this person, all the information that they would have submitted for the loan, the employment history, their current contract, their pay slips, their, if it comes down to them even asking for a balance sheet of their expenses and income and expenses, then, and the liabilities, if it comes to that, to assess the person, then they will do that. So they would have done that and realized that this person poses a risk. They could be delinquent after a while if certain things do not happen. If they do not get their loan, their contract renewed, they will be in a situation where they cannot continue to service the loan. So the same thing the financial institution did, you have to do for that same person. You have to assess them. The only difference is that the bank doesn't know them personally. You will know them personally. Well, hopefully you know this person personally before you think about even signing as a guarantor. So you may know this person personally. The financial institution does not know them personally. So that's an added benefit for you. So you could assess that. Assess the lifestyle and everything that you know them to be having, their employment history, all the information, and then from that you determine whether it's safe for you to sign as guarantor or if it's a risk for you to sign as guarantor. But personally, I would say avoid it at all costs. If you could avoid signing as a guarantor, I've seen persons lose assets because of signing as a guarantor for someone else's loan. So avoid it if you could. But if it's a close family or friend, you could consider it, but make sure all the boxes are checked out. And another thing is, if a borrower is trying to access a loan and they cannot service this loan, or they're not in a position to get this to service the loan, they shouldn't even be trying to access a loan or even trying to get this asset. And let me give you a simple case. Someone could be driving, say, a old Nissan B11. It's doing it's doing what it's supposed to be doing. You're getting from A to B, and they decided one day that they want to go and purchase a BMW SUV, a $300,000 BMW SUV, and they have a 2-month renewable contract, and the income and expenses, it suggests that this would be a big burden on them to continue servicing that loan. They shouldn't. In that event, you look at it and they're asking you to be a guarantor. You look at it and you realize they don't really need this. They don't need a $300,000 BMW. They may need probably a $60,000, $70,000 Tida, which is going to get them from A to B. So in all of this, you sit down with whoever you are going to sign as a guarantor. You sit down with them and determine what they really need this loan for, and if they really need the loan. And if you could assess that they really do not need to go into that kind of expense, you could avoid signing as a guarantor at that point in time. So I hope this was very beneficial to you all on another episode of Things to Avoid signing as a guarantor. And if you have to, make sure all the boxes are checked and that you are not at risk of losing any assets. I'll see you all on another one.